The lights of New York City glow against the night sky. Money is moving. Markets are open somewhere in the world, and behind closed doors in Washington, a small group of people is making decisions that quietly shape the value of every dollar you own. In 2021, Americans felt something they hadn't experienced in decades. Grocery bills jumped, rent surged, gas prices exploded. Inflation wasn't a headline anymore. It was personal. But inflation doesn't just happen. It's fought, and sometimes, it's controlled in ways the public never fully sees. This is the story of the Federal Reserve's quiet battle against inflation and what it truly means for your money. The year was 2020. The world shut down almost overnight. Businesses closed. Flights stopped. Millions lost jobs. To prevent a complete economic collapse, the Federal Reserve took unprecedented action. Interest rates were cut to nearly zero. Trillions of dollars were injected into the financial system. Money became cheap. Too cheap. By 2021, demand roared back. Supply chains broke. Prices climbed faster than wages. At first, officials called it temporary. But by mid-2022, inflation crossed 9%, the highest level in 40 years. That's when the tone changed. At the center of the storm stood one man, Jerome Powell. In press conferences, his words were calm, but behind them was a message Wall Street understood clearly. The Fed was ready to slow the economy, even if it hurt. Interest rates began rising. Fast, aggressively. This wasn't random. It followed a playbook written decades earlier. In the late 1970s, inflation was destroying American households. Gas lines stretched for miles. Confidence in the dollar was collapsing. Then came Paul Volcker. Volcker raised interest rates above 20%. It caused a brutal recession. Businesses closed. Flights stopped. Millions lost jobs. To prevent a complete economic collapse, the Federal Reserve took unprecedented action. Interest rates were cut to nearly zero. Trillions of dollars were injected into the financial system. Money became cheap. Too cheap. By 2021, demand roared back. Supply chains broke. Prices climbed faster than wages. Higher rates made borrowing expensive. Mortgages doubled. Credit card interest exploded. Companies that depended on cheap money began to crack. In March 2023, a shockwave hit Silicon Valley. Silicon Valley Bank collapsed in days. Not because it was reckless, but because rising interest rates destroyed the value of its assets. This wasn't an accident. It was a side effect. The Fed knew something would break, because controlling inflation isn't about prices alone. It's about behavior. Higher rates slow spending. They cool hiring. They reduce risk-taking. In simple terms, the Fed makes money painful enough that people stop overusing it. This strategy has a name: demand destruction. It sounds harsh because it is. The same tool was used after the 2008 financial crisis, when institutions like Lehman Brothers collapsed, exposing how fragile the system really was. Since then, the Fed has walked a tightrope, balancing growth and stability, confidence and fear. By 2024, inflation began easing. Not gone, but controlled. Mission partially accomplished. But here's the part most people miss. When interest rates rise, savers win. Cash earns again. Bonds become attractive. When rates fall, borrowers win. Assets inflate. Debt feels lighter. The Fed doesn't pick winners. It changes the rules and lets preparedness decide who survives. This is why wealthy investors watch the Fed more closely than elections. Why markets react to a single sentence in a press conference. Why your savings account, mortgage, and investments move even when you do nothing. The secret isn't that the Fed controls inflation. The secret is that inflation controls behavior, and the Fed controls inflation. For everyday Americans, the lessons are simple but powerful. Understand interest rates. They are not background noise. Avoid excessive debt when money is cheap. Cycles always turn. Build emergency savings rate hikes. Expose weak balance sheets. And never assume stability is permanent, because the next plan is already being discussed in quiet rooms with serious faces. And when it begins, the effects will reach your wallet before the headlines explain why. So here's the question that matters most. When the next shift comes, will you understand what is happening? Or will you only feel it after your money starts disappearing?